Think about your own habits for a second. When you keep physical cash in your wallet, or when your family sets aside savings in a bank account, why exactly do you hold on to it? Economists look at those everyday choices and recognize that saving isn't random. They group every reason we hold money into a specific three-part framework. These are the three foundational pillars for holding money: the transaction motive, the precautionary motive, and the speculative motive. Grasping these three individual motivations is the necessary first step. Once you know why a single person holds on to their cash, you can understand how money flows through the entire national economy. Let's map the three motives. Transaction covers routine expenses like groceries and payroll. Precautionary is a reactive buffer against emergencies, like medical bills or broken machinery. Speculative is proactive, holding cash to opportunistically invest in undervalued real estate or stocks when prices drop. Notice the contrast here. You hold precautionary money to shield yourself from disaster. You hold speculative money to position yourself for future profit. If individuals and businesses constantly set aside cash, where does it physically go when not pocketed? Institutions act as a bridge through intermediation, lending household deposits to borrowing businesses. They provide liquidity, acting as a tap of short-term credit to keep operations flowing. They also facilitate payments, manage risk, mobilize savings, maintain stability, drive financial inclusion, and provide credit information. Without institutions acting as intermediaries providing constant liquidity, saved money sits idle, and economic growth stalls. Here are the players. Commercial banks handle everyday loans. Credit unions are member-focused. Investment banks raise corporate capital via stocks and bonds. Pension funds grow retirement savings. Insurance companies manage risk, and the central bank sits at the top, implementing monetary policy to control inflation. Let's test this. Imagine a local business owner keeps physical cash locked in a safe, specifically in case their delivery van breaks down. Based on our framework, which motive does this represent? Pause here and think about it. The answer is the precautionary motive. They are protecting themselves against an unexpected breakdown. And if that repair costs more than the cash in the safe, a commercial bank would be the institution they turn to for a quick, short-term loan. Take a moment to discuss this with your peers. Look at your own community. How do these financial institutions actively contribute to local businesses and neighborhoods around you? If you're looking at the big picture in Ghana, it all traces back to this building. The Bank of Ghana operates as the central bank, serving as the ultimate regulator to stabilize the entire national economy. As we finish, consider this. Why is precautionary saving vital for your own personal stability? And out of all the institutions we listed today, which ones do you interact with the most, whether it's through mobile money or a local branch? You now have the complete map. You know the three personal motives that drive us to hold money, and you can identify the 6 key institutions that put that money to work across the economy.